Today, I have a short lecture covering the stock market crash and its immediate impact on the American and global economies. The stock market crash of 1929, to an extent, came out of the blue. We didn't have things like minute to minute newscasts like we do nowadays. So, there wasn't a lot of advanced warning as to the economic catastrophe that was looming around the corner. The Roaring Twenties had been the longest period of growth on the New York Stock Exchange in history. Stock prices rose to unprecedented new heights. The Dow Jones Industrial Average, which is a watermark for the overall health of the stock market, increased by six times from 63 in August of 1921 to 308 in September 1929. After prices peaked, a notable economist named Irving Fisher proclaimed, quote, stock prices have reached what looks like a permanently high plateau, end quote. He was not right. Economic growth of the 1920s was really driven by a couple of individual industries, perhaps the most important, which was the ownership of the automobile, which created tons of demand for all kinds of new industries. It's hard to imagine today, but you can picture in a United States landscape that doesn't have any gas stations. All those have to be constructed. All that economic growth. There's going to be a demand for mechanics for the first time ever, a demand from everything that you need for your cars. There's also demand for new houses in general, plus appliances. And move to housing in general was sort of, for the first time ever, a realistic option for a much bigger part of the population. New products and new processes of producing these products continued to drive economic growth throughout the 1920s. Plus, the combination of the widening use of electricity and the growing adoption of the moving assembly line in manufacturing continued to bring a rise in productivity. So prices dropped for items, meaning that middle wage workers for the first time could afford some of these things. Essentially, demand for some of these things remained constant throughout the 1920s, though in a few instances, there are several industries like railroads and coal production where it actually declines. New products and services created new markets, such as markets for radios, ice boxes for the first time, electric fans, electric lightings, irons, vacuum cleaners, other labor saving household appliances. And this electricity was distributed by growing electric utilities. All of that infrastructure as well had to be built. The stocks of these companies is what helps to create the stock market boom of the late 20s. RCA, one of the best producing stocks of that era, paid no dividends, but its value continuously appreciated because of expectations for the company. So, like the internet boom in the late 1990s, the electricity boom of the 1920s fed a rapid expansion in the stock market. The other thing that we have going on here is that ordinary men and women are investing growing sums of money in stocks and bonds. And a new industry of brokerage houses starts to occur for the first time ever. There's investment trusts and things like margin accounts. Margin accounts are things that just about any investor will tell you to stay away from if you have the least bit of risk aversion in your body. So here's how a margin account works. Purchases of stocks are driven by a fraction of the price. So the person who's buying the stock, let's say it's me, I put down a very small amount. Let's say I put down 10% and I borrow the rest of the money from the brokerage firm. So I'm borrowing 90% of the cost of the stock from the brokerage firm, who I'm paying a commission, of course, and I'm going to pay that money back later. And the idea is that the stock that I just bought is collateral for the loan. That's why they're willing to lend it to me. Now, if money goes up dramatically in the stock market, so if stocks rise in value, that's fine because I can sell the stock for a profit and I can pay off the loan. But there's another problem. If I bought, let's say, $10,000 worth of marginable stocks with 5 grand of my own money, and then 5,000 for the rest, I own $10,000 in stock. But what happens if that stock loses value dramatically? So if that stock suddenly is only worth $5,000, that's a best case scenario, by the way. So it got halved in value. I can sell it. I can repay the loan, but I'm out the $5,000 that I put into it. And there were warning signs on the horizon for the economy. Wages remained basically stagnant throughout the 1920s. What that means is, after people have been able to afford some of the lower ticket items, it's harder for workers to afford to keep buying. And if we have a consumer based economy, and really for the first time in history, the United States is turning into a consumer based economy. Well, if your consumers can't buy things, then we've got problems. There was also a huge proliferation of debt, and this is going to be a major problem. Banks were loaning out money like they could print it. People were borrowing sums of money for the first time. Buying on credit for the first time ever was a thing. You could go to the store and you could purchase something even if you didn't have the money in your account to pay for it. And people were doing that, and they were doing a lot of it. Plus, there was a struggling agricultural sector. Farms and farmers have been in the red since the late 19th century. So, since the 1890s, farming has not been profitable. And on top of all that, all of these bank loans, all of the money that they're lending out it's not what's called liquid capital, which means if I lend you money and the collateral is your house and your house is worth something, then I can sell that house if you default on your loan. But if I lend you money with no collateral, or if collateral that isn't worth anything, then that loan isn't liquid, which means I can't get it back as a bank if you default. And that's essentially what's going to happen. So prices start to decline in September and early October 1929. And then on October 18th, there's a big drop in stock prices. Panic sets in because as people start selling stock, the price drops. Well, you don't want to sell your stock for a huge loss. So everyone panics and everyone goes and they sell their stocks at the same time. On Black Thursday, which is October 24th, 1929, a record 12,894,650 shares are traded. For back then, that's an unbelievable amount of trading. And the only reason that there is that much trading is because prices are going down like crazy. So investment companies who have a lot to lose if the stock market goes down that much actually tried to intervene. Leading bankers, big companies tried to buy up huge amounts of stock with an effort of trying to keep the prices artificially high. This is something that we still see happen. We saw happen in 2008 as well, but it wasn't enough. By Tuesday, October 29th, things went even worse. There was an all time sell off at the Wall Street stock market exchange. It was a massively destructive day. Millions, literally millions of dollars were lost in a couple of hours. And again, if you look at the numbers, this pales in comparison to what we would see in the late 90s and then again in 2008. But that's just because there's so much more money, because the scale of the economy has grown so much. If you were to scale up the disaster that was the collapse in October 1929, it would blow 2008 out of the ocean. Now, in and of itself, the stock market collapse in October of 1929 does not cause the Great Depression. It's the trickle down. So, after October 29th, 1929, realistically, stock prices have nowhere to go but up. It would actually be a great time to buy if you could buy. So, there was some recovery over the succeeding weeks. But overall, the loss was unbelievable. Prices continued to drop, and by 1929, if you owned a stock, it was only worth 20% most likely of what it was worth in the summer of 1929. That's less than 3 years later. So if you paid $100 for a stock in GE, it'd be worth 20 bucks. You'd lost 80% of your investment. But the biggest problem is margin, because paying in margin for stocks proved not to work. Banks who lended money to people who bought stocks on margin suddenly had no money themselves. The banks are unable to make their loan payments. If the bank isn't paid back its money, then it has no money to give to anyone else. And by 1933, 50% of American banks had failed. Now, this is before the FDIC, the Federal Deposit Insurance Corporation. That nowadays insures your money in the bank. And that's one of the things we'll talk about that FDR is going to push for as a result of the Great Depression. But there wasn't any back then. So if you put your money in a bank that was very aggressive in lending that money out and then they didn't get it repaid, you lost all your savings. And there was nothing you could do about it. It was just over. When everybody loses their money, obviously the bottom falls out of the consumer based economy. And by 1933, 30%, almost one out of every three Americans were unemployed. 30% is a massive number for unemployment. And all of this is going to pitch the United States and then the entire world into the Great Depression.